Anthropic goes public this fall. What does it mean for San Mateo County housing? Everyone on the Peninsula is circling one data on the calendar, October. That is when Anthropic is expected to ring the bell on the NASDAQ in what could be one of the largest public offering in the market history. And here's what I need you to hear before anything else, that the date is not the date your housing market changes. October is the headline. April is the housing event. If you are planning to buy in Menlo Park, Atherton, Woodside, or anywhere else along the corridor, and you've been telling yourself you'll wait and see what happens after the IPO, you're not being patient. You're walking straight into the crowd. I'm going to show you exactly why, using the actual filling timeline, actual lookup rules, and the actual numbers coming out of our MLS right now. Stay with me, because the second half of this video is where the real opportunity is hidden. Hey, I'm Disen Cai. My team and I sell real estate here on the Peninsula. This is the market I live in, work in, and drive every single day. I make these videos for one reason. There is an enormous amount of noise about Bay Area housing, and the most of it comes from people who never sat in a bidding war on Santa Cruz Avenue or walked the client through an Atherton estate at 7 in the morning because that was the only private showing window we could get. And here's my promise for the next 20 minutes. You're walking away understanding 4 things. 1. What's actually confirmed about the Anthropic offering versus what's just chatter. 2. What that wealth realistically lands on the Peninsula, neighborhood by neighborhood, and what these neighborhoods actually feel like to live in. 3. The timing mechanic almost nobody talks about, which is the single most useful thing in this entire video. And number 4, the specific set of moves for sellers and a specific set of moves for buyers, based on where they are in the calendar right now. If you get value out of this, hit like and subscribe. It genuinely helps the channel reach the people who need it. Let's get into it. The money and where it actually lands. Let's start with what's real, because there's a lot of speculation floating around, and I don't want to build another 20 minutes on top of a rumor. Anthropic filed confidentially with the SEC on June 1st of this year. That part is confirmed and widely reported. The company is targeting a NASDAQ listing in October, with Goldman Sachs, JP Morgan, and Morgan Stanley leading the offering. In mid-July, Bloomberg and CNBC both reported that underwriting banks that had started scheduling investor meetings, which is the opening move of a roadshow. That's a real signal. Roadshow typically runs 4 to 8 weeks ahead of a listing. Now, the honest part, Anthropic has not confirmed the date. No ticker has been announced. October is a target, not a certainty, and IPO timelines slip all the time. The last private valuation was $965 billion, set in a $65 billion round that closed in May. Bankers quoted by Bloomberg now treated a debut above $1 trillion as the base case. So what does that mean for housing? Redfin ran the math in early July, and the numbers stopped a lot of people cold. Their analysis estimates that current and former employees of Anthropic and OpenAI combined will hold enough post-tax equity to buy roughly 29% of every single home in San Francisco metro area. Not every home is for sale, every home, period. Anthropic's share of that is about 9%, which Redfin models at roughly $63 billion after tax. I want to be careful with these numbers because it deserves a caveat, and Redfin says so themselves. Anthropic has never publicly disclosed how much of the company employees own. Redfin estimated it at 10 to 15% based on comparable late-stage companies. That's a reasonable assumption, but it is an assumption. The real figure can land outside the range in either direction. It is a model, not a disclosure. But here's a part that matters more than the headline, and it is the thing most coverage gets wrong. Anthropic is not a Peninsula company. Neither is OpenAI. Both are headquartered in San Francisco. There's no new campus coming to Menlo Park. Nobody is building a shuttle stop in Woodside. So how does this reach us at all? It reaches us the way tech wealth has always reached us, not through office addresses, but through life stages. A 28-year-old engineer who got liquid stays in the mission. A 36-year-old with a 2-year-old toddler, another baby on the way, starts looking at school districts. And when a Bay Area household with real money starts looking at school districts, the search narrows fast. Las Omidas, Menlo Park City, Portola Valley, Woodside Elementary, and Burlingame High. That's the pipeline. It is slow, it's demographic, and it's remarkably consistent across every liquidity circle this region has ever had. And it is already showing up in the numbers. Look at Menlo Park. Reference closest sale data through May put the citywide median at about 3.29 million, up 8.6% year over year. The competitiveness reading is at about 93 out of 100. Homes are going pending in about 7 days at roughly 5% over list. The hottest listings are clearing 14% over asking in about a week. 14% over asking on a $3 million house. That's more than $400,000 above the number on the sign. Now zoom into West Menlo Park specifically. Same data set, same quarter, the sub-market's median come in about 4.2 million, up 31.7% year over year. That's right, same city, same 3 months. One neighborhood appreciating at roughly 4 times the citywide pace. I want you to picture what that actually buys, because a number alone doesn't tell you anything. West Menlo is the flat, quiet grid west of El Camino. Wide streets, mature oaks that arch over the road so the light come down in pieces. Ranch homes are lots that would be considered generous anywhere in California and are considered enormous here. You can walk your kids to Las Lamitas. You can bike to Sharon Heights for coffee. On a Saturday morning in the fall, the whole neighborhood smells like somebody's smoker going in the backyard 3 houses down. And half of the block end up at that barbecue by 4 o'clock. That's what people are paying 31% more for. Not square footage. That specific feeling of a neighborhood where your kid can ride to a friend's house and you don't have to think twice about it. Now, that number tells you what the top of the market is doing. But you are not buying a headline. You are buying into a specific set of conditions. So let's zoom out and look at the market you'll actually be walking into today. Thinking about relocating to the San Francisco Bay Area? Well, I got just a thing for you. My team and I have actually taken the time to create the ultimate relocation guide, which is meant to save you hours of research, and I've linked it down below. From top employers, the best hospitals, and a boatload of other things that you will need to know before making the move, the best part about this guide is 100% free. That's right, you heard me right, 100% free. Just click the link in the description or the top pinned comment. Hope that helps. The market you're stepping into right now. Here's a county level picture as of this summer. San Mateo County single-family homes closed in June with a median price of $2.15 million, up 7.5% year over year in the multiple listing service data. Condos moved even harder, up about 12%, 787,000. Single-family homes are going pending in around 22 days, and they're selling at roughly 4% over the final asking price. Inventory is the story underneath all of it. Single-family listings across the region are down more than 26% from a year ago. New listings are down about 10%, but sold listings are actually up close to 7%. Read these 3 numbers together because they matter. Fewer homes are coming to the market, and buyers are absorbing them faster than they are arriving. That's not a demand problem. That's a supply problem. And the supply problems don't resolve themselves quickly in a county where roughly a third of the land is protected open space. Now, mortgage rates. Freddie Mac's weekly survey put the 30-year fix at 6.69% as of August 6, up slightly from 6.66 the week before. A year ago, it was 6.63. The 15-year fix is sitting at around 6.01%. So rates are essentially flat. They've been fairly narrow band for a while now. And the price point we're talking about on the Peninsula, a lot of these transactions are cash or heavily down conventional anyway, which mutes the rate's sensitivity considerably. But here, well, I have to give you the other side because I'm not interested in selling you a one-directional story. This is not a rising tide, it is a split market. While San Mateo County was up 7.5%, Santa Clara County went the other direction. Their single-family median came in about 1.92 million, down roughly 8.6% year over year. Their condo market dropped nearly 12%. Same region, same quarter, opposite directions. Why? Because the tech labor market isn't one thing anymore. San Francisco is absorbing an AI-driven wealth effect. Parts of Santa Clara County are absorbing layoffs from an older generation of tech employers. San Mateo County sits geographically and economically between these two forces. And right now, it's benefiting from the first one more than being dragged by the second. That could change if layoffs brought them beyond what they are today. This county is not immune. Nobody should tell you otherwise. I'll also point to something I noticed a couple of months ago in the local reporting, and I think it is one of the most accurate description of this market I've read. The Peninsula right now is a tale of two buyers. There is a confident, well-capitalized group competing hard at the top, and there's a much more cautious group in the middle, watching layoffs, the rates, and global headlines, waiting for a clearer signal. If you are in the second group, I understand it completely. Just know that you are waiting along a lot of people, and the thing you are waiting for may not arrive in the form that you're expecting. So, let's take stock of where we are. I opened by telling you October is the headline, and April is the housing event. You have now seen the first half of why. Anthropic's filing is real. The roadshow has started, and reference modeling suggests somewhere around $63 billion in post-tax employee equity attached to that one company. You have seen West Menlo Park running 31% above last year, the county up 7.5%, and inventory down more than a quarter. What you haven't seen yet is mechanic, the specific reason that the calendar works the way it does, which is coming up next. It is genuinely one of the most powerful 90 seconds in this video. After that, we're going into the estate belt. Atherton, Woodside, Portola Valley, that's actually happening at the top of this market. While the published median prices for these towns are close to useless. And what a record year there really looked like. And then we'll close with the second wave, OpenAI, and what a two liquidity event cycle means for your timing. Quick pause before we go further. If you are relocating to the Peninsula, or you are already here and think about moving within, I put together a relocation guide that goes deeper than I can in the video. It breaks down every city in San Mateo County, commute times, school attendance boundaries, where your dollar actually get you block by block, and the neighborhood character stuff that no listing site will ever tell you. It is free, the link is in the description, and it will save you a lot of weekends. Alright, the mechanic, the revelation. The date on the calendar is wrong. When a company goes public, employees do not get the money that day. There is a contractual restriction called a lockup. Standard terms prevent employees and insiders from selling shares 180 days after the listing. Some larger issuers use a shortened or staggered structure, sometimes around 120 days, often tied to a second earnings report, but 180 days is the default. So do the math with me. October 2026 listing, add 180 days, you landing April 2027. That is paper wealth becomes a down payment. That is when an engineer can write a non-contingent offer. That is the moment the housing demand actually shows up. The IPO bell is the news event. The lockup expiration is the housing event. And that timing lands on the Peninsula in the worst possible way if you are a buyer. April is already our most competitive month. Spring inventory, spring buyer pool, families try to close before the school year runs over. Now imagine dropping a fresh wave of liquid, motivated, well-capitalized buyers into the exact window. That's a collision I want you to see. Not October, April. Now, one important wrinkle, and this is where the cycle is genuinely different from the ones before it. Some of this money is already here. Reporting out of San Francisco this summer, notice something agents up there had never seen before. Employees at these companies have had access to liquidity ahead of the IPO through tender offerings and secondary sales. In past cycles, everybody waited for the lockup. This time, the meaningful slice didn't have to. One San Francisco broker described sellers marketing homes with an unusual pitch that they will consider taking pre-IPO stock as part of the purchase price. I didn't expect that to become normal, and I wouldn't advise it. The fact it's happening at all tells you how much money is already circulating before a single share has traded publicly. So the picture is layered. Some capital already landed. That is part of what you're seeing in Menlo Park's number right now. The larger, broader wave is still ahead of us, and it is calendared for spring. If you want to see where a wave like that concentrates first, you don't look at the county median. You look up the hill, the estate belt. Atherton, Woodside, Portola Valley. Let me start with the warning about the data up here. Because if you have been researching these towns online, you have probably seen the number that contradict each other widely. For Atherton alone, depending on which source you pull and which month, you'll find a median price around 7.4 million or around 11 million or higher. These are errors. They're a sample size problem. Atherton records somewhere between 30 and 50 sales in an entire year. In June, 12 homes were sold. 12. When 2 of these 12 happen to be $20 million estates, the median jumps by millions, and it means nothing about the underlying market. And a significant share of Atherton's highest value transactions never hit the multiple listing service at all. They are handled privately, agent to agent, and never showed up in any published statistics. So ignore the medians up here. Look at the shape of the market instead. A multiple listing service analysis published last month looked at 25 highest priced Atherton sales every year going back to 2016. In 2016, exactly 0 homes sold between 20 and 30 million, and 1 sold above 30. By 2025, 7 homes sold in that 20 to 30 million band. And for the first time, a majority of Atherton's top transactions cleared 20 million. Through the first half of this year alone, 4 homes has already sold above 30 million. And this isn't just an Atherton story. Just this month, a Hillsborough estate sold for record $70 million to a buyer reportedly working in AI. Another sign of just how much wealth is already moving through the top end on the Peninsula market. That's not price appreciation. That's a market that grew a whole new tier that didn't exist a decade ago. Look at the broader luxury segment too. In February of this year, across Palo Alto, Los Altos Hills, Menlo Park, Atherton, Woodside, Portola Valley, and Hillsborough combined, there were 40 closed sales above $5 million. February of last year, a 33% increase, and not because of just one outlier. Woodside's median climbed to roughly 5.8 million by March, up about 27% from the year earlier. A Woodside probably closed at 25.5 million early this year. An Atherton estate with a retractable glass wall drew multiple offers over the asking and closed at 30 million in April. Now, let me tell you what these places actually are, because the numbers make them sound like trophies, and they're not. They are neighborhoods. Atherton is quiet in a way that's genuinely hard to describe until you stood in it. No sidewalks, no streetlights on most streets, hinges and gates and long driveways. And behind them, a lot of families who are far more normal than you'll expect. West Atherton is particular in silent. The northeast side near El Camino pick up country noise, which is a real permanent difference between 2 addresses that look identical on a map. On a summer evening, the loudest thing you'll hear is a sprinkler system and somebody's kid on a diving board. Woodside is a different animal entirely. It is horses and railroads and hairpin turns. You'll be behind a rider on Canada Road on a Sunday morning, and nobody's in a hurry about it. There is a general store, a couple of restaurants where the same people eat every week, and about 90 minutes of hiking within about 5 minutes of most front doors. People who buy in Woodside are buying the land and quiet and the specific pleasure that driving home through a tunnel of trees. Portola Valley is the one outpoint relocating families towards most often. And its data tells the interesting story right now. Redfin's 3-month across median came in about 4.6 million, essentially flat year over year. But the multiple listing service data for June specifically showed a single-family median of 3.55 million, down about 1.4% with 11 active listings and 1.7 months of inventory. Both are accurate. They are just measuring different windows and different mixes in a town where 10 to 13 sales make a month. Portola Valley is meadows and oak woodland with the ridgeline right there. Over 1,900 acres of permanent open space. Windy Hill Trailhead is a local errand, not a day trip. The town center has a farmer's market that functions as a weekly social event more than a grocery run. Morning fog sits in the low spots and burn off around 10. If you want the peninsula without the density, this is it. Here's a strategic read on all three. These markets are supply constrained in a way that isn't fixable. Zoning, topography, open space protections, and lot minimums means Woodside and Portola Valley are not adding inventory in any meaningful way, ever. Atherton has 0.83 months of supply as of June, and homes there are closing above asking. When new liquidity arrives at the top of the market with a permanently fixed number of homes, it does not get spread thin. It concentrates. Which brings us to the last piece. And the reason I think the timing conversation is bigger than a single company. The climax. This isn't one wave, it's two. Anthropic isn't the whole story. It is the first act. OpenAI filed confidentially on June 8th, 1 week after Anthropic, but the New York Times reported in late June that the company is leaning towards pushing its listing into 2027 rather than going out at a valuation below $1 trillion. Sam Altman has reportedly treated a lower number as a non-starter. Traders on the Kalshi prediction market currently puts roughly 59% odds on the OpenAI IPO being announced by 2027, and about 73% by June 2027. And OpenAI is the biggest of two by employee equity. Redfin's estimate puts current and former OpenAI employee stakes at roughly $135 billion post-tax, more than double the Anthropic figure. So run the calendar out. Anthropic lists in October. Lockup expires around April 2027. The first wave hits the peninsula in spring. OpenAI lists sometimes in 2027. Lockup expires roughly 6 months later. Second wave lands late 2027 or into 2028. Two liquidity events, roughly 12 to 18 months apart, both aimed at the housing market that just posted a 26% drop in inventory. Now I promise no crash talk and no hype. So let me give you the counterweight because it's real. SpaceX went public in June 12th, priced at $135, raised $75 billion, and jumped 19% on day one at $160. Estimates suggest it created roughly 4,400 new millionaires overnight. From there, it ran up to $202. And then it came back down to about $153 within weeks. So the stock is still above where it's priced. I want to be precise about that because I've seen this example used sloppily. Nobody who bought the offering is underwater. But look at what happened between the peak and the pullback. Anyone doing the mental math on their net worth at $202 watched about a quarter of that number evaporate in a matter of weeks. And here's a part that connects back to everything we just talked about. Because of the lockup, most employees couldn't have sold at $202 even if they wanted to. They were locked in and watching. And that's the reminder. Paper wealth is not cash. And the number on your screen that peaked is not the number you get to spend. Some of these employees will reach their lockup expiration holding a stake worth meaningfully less than what they were mentally spending on it. Some of the housing demand people are modeling today will simply not materialize at the size they're modeling. which is exactly why I'm not telling you prices are going to spike. I'm simply telling you something narrower and more defensible. Right now, there is a window or a known supply constraint and the scheduled liquidity event have not yet met each other. That window closes in the spring. What happens after that depends on the market, nobody can forecast. So here is the playbook, and it is short. If you are selling, listing into the fall, not because of the bidding frenzy from newly minted millionaires in October. That's not how the lockup works. List into the fall because inventory is down more than 26%, because homes are clearing at roughly 4% over the asking price with 22 days on the market, and because you'll be selling into a market with almost no direct competition and a buyer pool that is watching the same calendar you are and is motivated to move before spring. Anticipation is a real force in this market and it's working in your favor right now. If you're in the estate belt, start the conversation early. These properties take longer to prepare, are often selling through private channels that requires lead time. If you are buying, act before liquidity concentrates. Every advantage you have today, negotiating room, inspection contingencies, a seller who will actually work with you on timing, gets harder to hold once a wave of non-contingent, cash-heavy offers enters the same neighborhoods you are shopping. Get fully underwritten right now. Not pre-qualified. Know your 3 target neighborhoods code so you can move in a weekend. And if you are relocating from out of state, start now, because the learning curve in this county alone is a month of your life. And that is the whole argument. October is the headline, April is the housing event. The gap between them is your window. And it is roughly a month wide as of today. Quick wrap up. Let me put it together. Anthropic filed confidentially on June 1st and is targeting a NASDAQ debut in October. That's a target, not a confirmed date. And it could move. Redfin models roughly $63 billion in post-tax Anthropic employee equity, with the caveat that the company's employee ownership has never been disclosed. Combined with OpenAI, that estimate enough buying power to purchase 29% of every home in San Francisco metro. Neither company is headquartered on the Peninsula. That wealth reaches us through life stages and school districts, not office addresses. San Mateo County single-family home closed in June at roughly 2.15 million median, up 7.5%, with inventory down more than 26%. Santa Clara County went the opposite way, down about 8.6%. So this is a split market and not a rising tide. Menlo Park is running 8.6% citywide, and West Menlo specifically at 31.7%. Atherton, Woodside, Hillsborough, and Portola Valley are supply constrained in permanent ways. And Atherton and Hillsborough has built out an entire new price tier above $20 million that did not exist 10 years ago. And the mechanic that mattered most, the 180 days lockup, puts real liquidity in spring of 2027, right on top of our most competitive season. OpenAI's second wave follows 12 to 18 months after that. Sellers list into the fall demand. Buyers move before the calendar closes on you. If you're thinking about moving on the Peninsula, whether that's a fall or sometimes next year, my team and I would love to talk it through with you. No pressure and no pitch. Just an honest read on your situation, your timeline, and which of these neighborhoods actually fits how you want to live. My contact info is in the description, and you can reach out however you prefer. And if you're early in the process, grab a relocation guide. It's linked below. It is free, and it covers every city in San Mateo County in more detail than I could ever get through in one video. Commute realities, school boundaries, what each neighborhood actually feel like on a Tuesday night. It is a thing I wish somebody handed to me when I started working in this market. If you want to go deeper on the estate belt specifically, I got a full video on Atherton, Woodside, Hillsborough, and Portola Valley, and how buyers should approach a market where half of the inventory never hits the multiple listing service. I'll put it on the screen now. Thanks for watching. I'll see you on the next one.